Hello everyone, welcome to class. This is another journey on our wealth creation, we're building, and right about now we're talking about bond investment, which is a secure path to your financial freedom. You've heard so much about bonds, we have different kinds of bond, and yet you still don't have a grip or a hold about what it is. I'm going to demystify everything to you. So we're going to the lecture proper. What are bonds? A bond is an instrument that represents a loan. Look at a bond as a loan, you giving out a loan to someone. So a bond is an instrument, it's a kind of instrument that represents a loan made by an investor. You are the investor in this case to a borrower. So you are the investor. You know, when you talk about you're lending money, you're borrowing money. So you are the investor, you are the one that is giving out the loan to somebody who is a borrower. And most often times the borrower could be the the government, or maybe corporations. And then in return, what do you get in return? You get interest, and also you get your capital. So you can look at a bond as an IOU, you understand, between the lender and the borrower. This includes, so when you look at it as an IOU, you have an IOU, you owe me something. So you have maybe like a memorandum, like a form that, okay, I'm giving you this loan, I'm loaning this money. So you are going to know, okay, for how long, what's the payment going to be like, what interest are you going to be paying me on this money I'm giving to you. So it's in simple terms, bonds are loans issued by investors to corporations or the government. Maybe maybe you could have like corporations, instead of them going to the bank to borrow money, maybe the likes of big corporations, let's say from like Dangote, MTN, FBN, all these. Instead of MTN going to the bank to go and borrow money, they can come and meet people like you and our investors that have excess funds in the economy and come to us to borrow money from us. Or invariably, the government can also come to you and I to borrow money from us. So, and also it is always at a fixed, it's always fixed, the period is fixed. There is a specified period. It's not an indefinite transaction that, oh, like the stock that you are going to be a stakeholder, you are going to be a shareholder, so you could be there forever, or you could be there as long as you wish to. This one has a specified time frame for it, and it also has a regular interest payment. So what are the key benefits of bond investment? Number one is that predictable income through fixed interest payment. You can know from day one how much will be your return. If you are coming to me as a borrower to take bond from me, you are going to tell them, I need 1 million naira, I need 500,000 naira, I need $1 million, and I'm willing to pay 20% per annum. I'm willing to pay 20% in 30 days. I'm willing to pay 20% in 275 days. It is fixed. So I know if I'm giving 1 million naira per annum and it's 20%, so I already know that 200,000 naira as interest is coming to me. Unlike the stock market that you don't know, you are buying the shares of a particular company. You don't know whether the company is going to do well or not. You don't know whether the company is going to pay dividends or not. So you are just investing with the hope, based on the fundamentals and the technical analysis you've carried, that, oh, this company is going to do well, their price is going to rally high, and as a result, I'm going to make a return upon it. But you are like, okay, you in anticipation, you are hoping because of all the analysis that you have done. But this one, you don't need to do any analysis. The company has come straight to you to say, give me this XYZ money, and I'm going to pay you this XYZ interest. So predictable income. So you can plan your cash flow. You can say, okay, I have this money, I need to get this return in this particular period over this money before I use it. So you know how much you are getting ab initio. The other key benefits of bond investing is that lower risk compared to stocks, because in the event of bankruptcy, a company will always give priority to its bond holders as against shareholders, because shareholders are part owners of the company. So you are more or less like, they will give preferential treatment to their creditors, to those people that they owe money. It's just like you too, maybe if a company, so it's just typical of any company that is going bankrupt, or in the event of anything, they pay their lenders first. So that is why the risk is lower But for stock, you can buy a stock now and the company will go down and you don't have anything. You are part, if the company is going up, you are part of the profit, and it's going down, you are part of the going down. But in the event of, for a bond, whether they make profit or not, they must pay you. So the risks, unless maybe there are critical issues, so the risk is quite lower to stock investment. Then number 3, in the event of liquidation, bondholders are paid first. I've said it, they are always paid first. Whereas there is bankruptcy, there is liquidation, bondholders are given priority as against shareholders. Those are key benefits of investing in bond. So another benefit is a diversification of your investment portfolio. Instead of loading and overloading your investment portfolio with just stocks, you can bring stability to your portfolio by investing in bonds, because they are way lower in risk terms as against bonds. So when you talk about diversification of bonds, that means you are not putting all your eggs in one basket. You are not just investing in stock, or you are not just investing in real estate, but you are diversifying. So it's a very good way for you to diversify your portfolio. So we want to look at the terminologies that you need to know when investing in bond. Number 1 is the issuer. Who are the issuers? They are the borrowers, such as a company or a government. So you can say MTN is the issuer, is using a bond, or the government is using a federal government savings bond. So they are the one they issue the bond to raise capital for projects. So they are called the issuer. Then we have the face value. That means the amount borrowed. That means also known as your principal. Maybe they could say, oh, they have the face value. They could say, oh, minimum of 5 million naira, minimum of 10 million naira. So that is your face value. That is the principal you're investing in. Minimum of 200,000. That's the principal. That is your face value. And they can say in multiples. Then when you know, say, okay, 200,000 in 5 places, that is 1 million. That is your principal. That is your face value. It's the same thing. Then we have the coupon rate. This is like the interest rate that is paid periodically. So some bonds might decide to be paying interest, which is the coupon, quarterly. Some might decide to be paying semi-annually, and some might decide to be paying annually or one-off. Maybe for like short-term bonds, they can say, okay, we're going to pay once, take your interest up front, or you take your interest at the maturity, at the end of the period of the bond term. So we have maturity date, the date when the bond expires. So if you are investing into a 91 days bond, that means by day 91, that is the maturity date. If it's a 364-day bond, the 364 is the maturity date. So the maturity date is okay when if I invest today, then maybe it's going to be in December, or it's going to be in March. That's the maturity date. Then we have the credit rating, a measure of the issuer's creditworthiness. You don't just give out loans. You are the borrower. You don't just give out loans to anybody. You are the investor, rather. You don't just give out loan to anybody. Anybody can't just come to you and say, oh, you can't just see any bond issued in the back and say, okay, we want to raise 500 billion, and then you just jump at it. You have to know the credit worthiness of the issuer, the person, the company, or the government that is raising the bond. So you have to. So there is always something that is called credit rating. So part of the credit rating that you are going to do is that you have to know, okay, in time past, maybe they issued bonds. How were they able to pay back? Were they timely in terms of their coupon payments? Were they timely in terms of the return of principal? So those are the things you need to look out for when investing in bonds. Then so we want to quickly look at the differences between stocks and bonds. One, stocks are equity instruments. So that means you're a part owner. You share in the goods and in the bad. Like the adage that says, the Yoruba adage that says, meaning that when a bed is with an owner, the good and bad of that or whatever is happening to the owner, you will stick with the owner. So that is what a stock is. Whether the company is doing so well, you enjoy the dividends, you enjoy the benefits, and invariably when the company is not doing well, you'll be part of it. So it's an equity instrument. So you are part of the owner, you are part of the company. So when they sneeze, when they cough, you are part of it. Whereas bonds are debt. you are borrowing them money. You know the way you say, I don't care, I borrow you money, just give me back my money. I don't care. In fact, give me with interest. So it's a debt instrument. Another difference is that the return on investment for stocks is not guaranteed. You can buy a stock today and you see 500%. You can buy a stock today and then in 3 months you see 100%. You can buy a stock today and in 2 months you see minus 50%. It's not guaranteed. So the return is not guaranteed. That a company will do well is not. Past performance of a stock does not guarantee future performance. So it's never a guaranteed source of investment. Whereas the return on investment for bonds is guaranteed. From day one, at the initial of that transaction, the company would have told you, we are paying 50%, we are paying 20%, we are paying 29%, we are paying 31%. So you just calculate 29% of the principal of the face value we are giving to them. So you know what interest is coming to you. Maybe you are going to be a discounted bond, or it's going to be a bond that will be paid at the end of maturity. So it's guaranteed. Then another difference is that stocks are high risk investment. It's quite risky. If you don't do there is a thin line between stock trading and gambling. If you just like, oh, maybe by true hype, and oh, they said this stock is doing well, you heard it on Facebook, you heard it on Twitter, on X, and then maybe on LinkedIn or something, I decide to buy it. It's a risky venture. You need to be able to get your fundamentals analysis, which is the financial health of the organization. You look at their PE ratio, you look at a whole lot of things, their turnover, their sales, their operating profits, and everything, to be able to assess that, okay, this company is a going concern. Even if the share price dip temporarily, it doesn't mean that the company is not a going concern. So yeah, so it's high risk investment if you don't do all those things and you just buy into stocks. Whereas bonds are low risks, they are guaranteed. Many corporations that come for bonds, they would have done a lot of their analysis back end to be able to say that, okay, we need 100 billion naira for this particular project. If we take this money for maybe 274 days, this is what we want to use it for. And by the end of that 270 days, or maybe 260 days, we would have done what we wanted to do with it, and we would have been seeing returns coming in that we'll be able to pay back those people that gave us the money. So the risk is quite calculated and it's quite minimal. Then stock owners of a company are regarded as shareholders, and they have voting rights during the decision making process. So if you have share in Nestle, you have the right. You being a shareholder comes with voting rights. You can vote in person or by proxy. So you can you can be part of their AGM, annual general meeting, and it's a very good way for networking. It's a very good thing. You go for their AGMs and you meet people, you network, you go with your business cards, and you can make decisions. You can decide whatever decision the company is taking part time, you can decide to vote for it or vote against it. So you have the right. But for a bond holder, you are regarded as a creditor. There's nothing that concerns you with the running of the organization, the decisions the management are taking part time. So you do not have any voting right during the decision making process. So there's nothing. They won't even try to seek your opinion. Whereas for stockholders, they might try to seek your opinion if they want to take a decision. Maybe they want to expand into Europe or something. It's part of you as a stockholder. You're supposed to be aware of such expansion or into another market, and then to be able to say, okay, I'm in for it or I'm not in for it. Then stock investment does not have a fixed time of maturity. You can still you can be there forever. You can be say, okay, I'll be growing, and then you are compounding your interest, compounding dividends, getting bonus 1 for 2, 1 for 12, and all that. You can be there forever. Or you can be say, oh, I'll be there for 5 years or 10 years or 20 years, as the case may be. So there is no maturity. There is no, when you're buying the stock, the company is not telling you that, okay, you are buying our shares and you will pay you back in another 1 year or 2 years. No, there is no such agreement. It's you that will not decide, okay, this company is a growing concern, is doing very well. It's even a company that I can give gifts to my children or children. I'll be in for the long haul. So it's you that will decide. There's no maturity to it. But bonds, they have a fixed time of maturity. You know whether you're buying a 90-day bond, you know whether you're buying a 180-day bond, or whether you're buying a 365-year bond, 65 days bond, or whether you're buying a 2-year or 5-year or 10-year bond. Even if it's a 10-year bond, even if you're buying a 30-year bond, you will know, okay, this bond I'm buying is for 30 years. I just need regular cash flow, predictable cash flow for the next 30 years to sort out this need of me. So you just know it has a fixed time of maturity. Whether it's 30 years, at the end of 30 years, you get your face value, which is your principal, back. It is guaranteed. So once the company, you've done your proper due diligence and you've done the credit rating and it's a going concern that in the next 30 years, this company will still be standing. You get your money back once that 30 years reaches. Then what are the diverse bond options? Different types of bond options that we have. We have the government bonds issued by the national government, and we have such in Nigeria. We have we have the federal government savings bond, which comes up every month, every first week of each month. So if you miss for this month, don't fret. Next month, the first week of the month, there's going to be another bond that will come up, another issue that will come up, and it's always for maybe 2 years, 3 years, depending. So we have that they are issued by government to meet short-term obligations, and we have some that is specifically for meeting long-term obligations of the government. Maybe they need to pay, maybe they need to fix a road or something. They just come to the public and take money. That's government bonds. We have corporate bonds issued by companies. You could have maybe large corporations like the likes of Dangote, banks coming up to issue bond, though they have shares, and they might decide, oh, we don't want to raise more shares, we just need short-term funds, maybe, or we need funds for a period of time, maybe 4 years or 5 years, or maybe for 1 year, less than 1 year. So you can have corporate bonds. We have municipal bonds issued by local authorities. So these ones are maybe it's common in it's common in the Western world, Eastern world, that okay, you see them municipals, they come, maybe they have a particular project that they want to do, they can raise fund, and then maybe the fund is the project is going to generate funds, is fund generating, so they can use it to pay back bond holders. Then we have subnational bonds. These are issued by state government as it is. Then we have Suko bonds. These are like ethical bonds issued by the government. Or some people refer to it as Islamic bonds, because really they have things that they invest in. They don't invest in everything, because they go by the tenets of faith of the Islamic religion. So some people that is not ready for Islamic religion practitioners. If you feel that, oh, I don't want if you feel that I don't want my bond my money to be used in maybe building hotels or something, you can go for Sukuk bond. So those ones are ethical bonds. Then we have junk bonds. These are like high yield bonds, because they are issued by companies with lower credit ratings. By the time you look at a particular company as, oh, this one, it has, maybe you could just say, okay, this company, maybe let's say Faithfulness Nigeria PLC, decide to, you don't even know the company, but they are doing well. Maybe you know that they do cables or something, but they are not a well-known brand, and their credit rating is quite low. They might, because they might decide to raise bond for expansion or for a particular project. You can key it to it looking at their credit rating. Of course, their yield, it is expected that the yield or the interest rate on such bonds should be way higher than a normal company that the credit rating is quite okay, because there is a risk premium to it. You are taking a risk, a higher risk, so there should be a premium to the risk you are taking. Then we have Euro bonds. These are issued by local authorities. Maybe it could be in Nigeria, but Nigeria government issuing bonds in foreign currencies. These are called Euro bonds. It could be in Nigeria, a Nigerian government issuing bonds, but in foreign currency. You as a Nigerian, you can also key into that investment, but it's going to be in dollar or in pounds or whatever currency that they issued it in. So it's not, you are not investing in Nigeria, in Naira. Then we have a bond fund. This contains hundreds or thousands of bonds. So the pulling together of bonds, maybe you could have junk bonds in it. It's just like you have a pool. You have junk bonds, you have government bonds, you have corporate bonds, you have Euro bonds, all together pulled in, and then of course they average down the risks and the return. So one of the things you need to do when investing in a bond is assessing bond ratings. And bond ratings are critical indicators of an investment reliability. You need to rate the bond. You don't just invest in bond blindly. We have credit rating agencies. We have like the Fitch, we have a Standard and Poor's, we have a Moody's. They rate bonds and they evaluate bonds based on their issuers, financial strength and ability to meet debt obligation. So if you look at, we have the bonds that are rated AAA, AAA, that they have their financial rating is quite very good, very okay, followed by the bond rating, the company with the rating of A. Of course, they are okay too, and you can also invest in them. Then followed by BBB rating. So it's just like WAEC giving grades to students. Do you understand? Maybe in English you have A, you have B1, you have B2, you have C. Do you understand? So this is the rating that you see for bond investment. You have B, you have C, you have D. And you see higher rated bonds. If you see those ones with the AAA bonds, they have lower rates. They are the large corporations that they even their base, their capital base is well over what they are coming to the market to make money for. It's just that maybe you have a company that has a capital base of about 3 trillion or 5 trillion naira capital base, and then they are coming to the market to just borrow maybe like 100 billion. Of course, even if anything happens, even if the project is not successful, their capital base can still absorb that loss and they can still pay bondholders back. Do you understand? So those bonds with higher ratings, they have lower rates and they offer lower returns. So if you are going for a bond with a rating of C or a rating of D, you should know better that you should demand higher return on that bond compared to a bond that is going for maybe AAA. So if a bond that is going for AAA, that has a AAA rating, is coming to the market and is offering 27% or 28%, and you have a company with a rating of C or a D, and it's coming to the public also to raise a bond and issue the bond, and is also willing to pay 27%, I will not invest in such bond. The only reason why I can invest in such a bond is that maybe you're offering me maybe something like 35% or 40%, and I must have done my due diligence and say, okay, this project is self-funding and it could pay back, and I could like, okay, it's a much higher risk, and of course I should take a more higher return for investing in that bond. Then what are the tips for investing in bonds? You must understand your risk tolerance. If you know that you're just like, okay, I'm a very risk conservative person, don't go for bond with a lower credit rating because they are offering you higher returns. For people that are risk averse or risk seeking, you can like, oh, okay, it should be 90 days or 274 days. I can clearly do it. I know I have been able to balance my portfolio to take this high risk. So you must understand your risk tolerance. The way your portfolio is structured, you must know that, okay, these are the things I can invest in, these are the things I cannot invest in. Don't just because, okay, every offer in the market, you jump at it. You must be able to read and understand your risk tolerance. Then know the bonds rating. We've discussed that. Know the bonds rating. A company that is rated C, you should know what you should be expecting and what you should be demanding, and whether it's something you can fit into your profile, investment profile, and investment appetite. Then keep track of maturity dates. If you could use a Google sheet or an Excel sheet and keep track. Oh, you invested in this bond, and then this is when the coupon should come in, and this is the maturity date. And if possible, you could set, if it's on Google Sheets, you could set a timer to it. You set a reminder to it, or you put it on the calendar so that there is another alert coming in that, oh, this coupon is supposed to be paid. We have some people that have bonds that are like 5, 6, or 7. They don't just stress. They put it on, they automate it, and they put it on the sheet, and it reminds them, and payments are coming in. So you must keep track. Don't just invest and then you can't even remember what you are invested in, or when, or the maturity date. And some of you just know that the maturity is passed, or I don't even know if I've repaid or not. No, you must keep track of the coupon payment and also of the maturity dates. Then what to watch out for. So bonds, we said bonds are security issued by corporation, government, or municipalities. So you must look at the interest rate risk. It's a major thing that you need to look at. Let me explain this. When you talk about interest rate risk, bond prices fall as interest rates rises. So if interest rates in the market is maybe like 30%, the price of the bond is going to fall. The bond price and the interest rate are inversely related, so they don't fall. So and it's a risk that is inherent in investing in bond, so you must know that, and you must be able to know how you can mitigate that risk. Then credit risk, that means risks of issuer defaulting on payment. So you can be sure that, okay, if a Dangote refinery is coming to the public to raise bond of 100 billion or 200 billion, and you know what the worth of a Dangote refinery, and then compared to another company that is well known and is coming to the market or to the public also to raise bond, you must know the risk of the issuer, that, oh, this one has a higher risk and this one has a lower risk. I'm sure of taking my money back because of the credibility and the financial strength of this company. So you must know what you're investing in, because it's a risk and you must be able to mitigate it. If you are going for a low rated company, of course you can. It's not as if you cannot, but you must know your risk appetite before you invest in such bond. The inflation risk is a risk that erodes the value of fixed interest payments. Of course, inflation is a risk for everybody. Even your money sitting down in your bank account, there is inflation risk to it. The money you kept last week in the bank that is doing nothing, there is a risk attached to it, which is the inflation risk. Also, when you have a fixed interest payment that is coming, maybe annually or maybe quarterly or semi-annually, sometimes you might also have reinvestment risk also to that money, that coupon payment that is coming in. So you must know how you should mitigate it. Then strategies for success. You must diversify across issuers and maturities. If you have you want to say, okay, a particular percentage of my portfolio is going to bond, you must be able to, don't just put it in a particular bond. Diversify across issuer. Maybe you do government, do corporates, then do junk bonds. At least you have spread your risks. Even though it's bond, you are still diversifying your bond investments. And there are cost maturities also. You have one that is maturing in 2026, another one is maturing in 2027. Do you understand? You have diversified your maturities. But then balance short-term and long-term bonds. Don't just go for long-term bonds and don't just go for short-term bonds. You must be able to balance them. Look at what is. You must sit down, be able to look at your profile. I always advise every investor to do their investment profile. Even before starting, you start to invest. If you don't do it, you just be investing blindly. Look at your investment profile, your tolerance, and your appetite for investment and for risk. Then that will inform you how you'll be able to diversify your portfolio. If you need help, I offer that service. If you need help, I can help you with it, so that you'll be able to know, okay, should I buy short-term bonds now or should I buy long-term bonds now? Because that is the way you can able to get the maximum from your portfolio. Otherwise, you're just investing blindly. Even if it's bond, and if you just invest and then you are even the main aim of investing, you are not achieving it. Then consider a mix of government and corporate bonds. Don't just go for corporate bonds. Don't just go for government bonds. Mix it together. Consider a mix of it. So if you want to quickly look at the reason why you need to choose bonds, we want to do a comparison between bonds, stocks, and the real estate. So when in terms of risk level, the bond has a lower risk compared to the real estate, and why the stock has a much higher risk for it. So that is it. So the stock is the most volatile when it comes to investing in stock. Is more volatile than real estate, and real estate is more volatile than bond. Their liquidity is high. Even if you invest in a 2-year bond and you wish not to stay till that 2-year bond, and you need your money maybe after a year or 18 months, you can go to the secondary market and sell your bond. That is the secondary market. You will find somebody that will always be able to buy from you, so you can sell your bond. So the liquidity is high. Also, likewise with stock market, you can also sell. You can buy a bond in the morning and decide to sell in the evening. If the market cap on the liquidity is, because it depends on the volume traded of that particular bond. We have some bonds that are trading in millions on every single day. So you can get to sell that kind of bond easily. But for real estate, it's quite low. You might put a house for sale, and maybe in 2 months, 3 months, you're here to see a buyer. You can be lucky in a week and you get a buyer, but it's highly you see put a property for sale today and get a buyer today. Even if you get a buyer today, the buyer is still going to do some his or her own due diligence, maybe doing search in the local doing search with the government to see that if this particular property is not encumbered or something. So it will take a while for all those documentations and formalities to be done. So it's quite low, so compared to the other two. Then the potential returns for the bond is moderate, for stock is high. You can see 1,000% return, you can see 200% return, you can see 500% return, you can see 30% return, you can see 40% return. It depends. And then for real estate, it is moderate. You know what? Of course, property properties appreciate. So you see a return, but it's quite moderate compared to as well as with the bond. The income stability is consistent. You're sure, okay, every quarter I'll be getting this kind of money. Every 6 months I'm getting this kind of. It is consistent. So if you are looking at building a consistent cash flow for yourself, the bond is your plug. Then the stock, the cash flow is variable. It depends. If you have 1 million units of a particular share, you can decide to sell 200,000. Do you understand? So it's variable. So the income stability is variable. Then real estate, the income stability is periodic. So are you willing to start your bond investment journey? I'm sure you have a grip of what it is about investing in stock, in bond. So secure your financial future with bonds. So try and diversify your portfolio with bond investments. I'll see you in my next class. Take care of yourself. See ya.